When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about, will a solid retirement plan make it through any economic storm? We'll also answer listener questions. And finally, DIY retirement planning, is saving the advisor fee actually costing you money? My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I am doing excellent. How are you doing?
I'm doing fantastic. Thank you. Now that we're here together on the radio, hope everyone else here in the greater Tucson area is having a great weekend. As always, we really appreciate you joining us here for Premier Retirement. Jeff, every week we talk about the markets, inflation, interest rates, employment, the Federal Reserve, and whether the economy might be slowing down. But let me turn this around just a little bit. If I have a really solid, and I mean solid retirement plan, should I really care about what the economy or the stock market is doing?
Well, I think you should. I mean, obviously, it drives a lot of different factors that make or break our lives in one way or the other. However, to answer your question more succinctly, it's just if you have a good plan, you've already built a plan to weather those storms, no matter what they are. Now, it doesn't mean your neighbors and friends aren't suffering. It doesn't mean your kids might get in a jam and need some help. Maybe you need to have some buffer for that. But if you want to take care of yourself and be financially free, financially independent, you need to have just certain things in place. And that is a guaranteed income source that you know that you're never going to outlive, so that you have that income coming in regardless of what happens. You can't just rely on a market that you can't predict to be generating endless income forever, even though I think Wall Street would love you to believe that. They've got the number down around 3 or 4%. That was a wise number to take out just so you don't lose money. But you can do a lot better than that with half your assets if you structure it correctly and still have money to play the market and to grow your assets for those future rainy day expenses or inflation if it happens and other things. But there's really the 5 pillars of planning. If you leave any one of them out, you're probably going to be left hanging. And to each person, it's probably got a different level of importance for each one that you need to focus on mostly. First of all, in retirement, we deal with typically what we call the mass affluent client. We're an advisor that focuses on the mass affluent. And that just means they're probably on average at least 1 million, probably the $2 to $5 million range in assets. Why is that an important level? Well, that's the important level that the person has saved enough to where they can, and they've probably lived a nice lifestyle with a high enough income that they want to keep doing it. And they've kind of maybe got good moderate spending habits perhaps, or they've been a super saver, either way. But bottom line is they probably want to still enjoy life at the same level as they did before. Now they've got new problems. They've been able to defer the taxes on what got them $1 million or $2 million or whatever it is that they have in retirement. They've deferred those taxes, and now they have to pay taxes as they use that money. They've also got to convert that nest egg into an income stream that might make up maybe $100,000, $200,000, $300,000 of income, or whatever you were used to making as a couple or even as a single person up to the time that you retired. So how are you going to replace that level of income to continue your lifestyle to retire on your terms? Now, granted, maybe you've paid down the house, you don't have car payments anymore, you're not going to be doing certain things that cause you a monthly payment, but you're still going to want to travel more. Maybe you want to buy that little dream cabin up in the mountains, want to do some things that may use some of the assets up. The bottom line, the biggest thing you're missing when you retire, whether you have a $50,000 a year lifestyle and $100,000 saved, or whether you have $400,000 a year lifestyle and $5 million saved, whatever it is, you're missing a paycheck now. And that paycheck is probably not going to be made up, no matter what level you're at, on a Social Security paycheck. So unless you have big pensions, maybe you worked several government jobs, maybe that would cover some of that income. And that's what we call annuities. Those are annuity incomes. Social Security is a great annuity. It actually has a cost of living increase based on inflation. That's nice. Problem is they take some of your Medicare premiums out of it. It's also taxed to a certain degree. It's not tax-free. They do give some credits back depending on your income levels, but it's a decent annuity. Most retirement plans that give you pensions are annuities. The problem is those incomes are fixed. They don't usually go up, but that's not necessarily a bad thing because during the early stages of retirement, you usually spend more than you do in the later stages of retirement. So if there is inflation, it doesn't usually eat into a level paycheck if you look at the 2 or 3 decades, maybe even 4 decades that you plan to be retired and spending that money. But the bottom line again is it's how are you going to replace that income stream that pays all the bills every month without relying on the market going up every month, month in, month out, year in, year out, and not taking a big 50% bath like it did in 2000, like it did in 2008, like it almost did in COVID, but they printed so much money they got us out of that one. And like the crash we're probably staring in the face of right now with the AI being so overvalued. Now they keep on faking out the bookkeeping and the earnings that they're presenting, including profits on stocks. So companies are buying each other's stocks, bidding them up and calling it income. So there's a lot of fake news regarding earnings growth and some of the success that a lot of the tech companies are having right now. We're kind of in that place again where the market could correct in a big way. So I would say, ask yourself, are you in a position that if you lost half of your assets that are market-based, and by the way, bonds can go down too. Just look at the 20-year bond, the TLT, which is basically the long-term bond, basically 20 years. That's down like 40 or 50% since its high a few years ago, and it's down 4 or 5% just this year. So you can still lose money in bonds. So that's not just the safe haven, especially with the pressure on interest rates to be going up in light of the inflation pressures that we're having. So got inflation to worry about. You got the next market crash to worry about. It's going to happen. We just don't know when because market crashes happen. It's not like, oh, we'll never have a market crash again. We've always had market crashes during different times, and they typically come when we least expect it, typically when the market is most euphoric, most pleased, and there's more hype about it than ever. And I think we're kind of seeing the writing on the wall now. Warren Buffett's 40% cash, so people are dialing it back. So how are you going to make income? Think about if your $2 million became $1 million, would you still be able to live on that $180,000 a year retirement lifestyle that you had planned? No, you'd probably have to cut back. In fact, there's a common new technique that says, well, that's okay. You shouldn't go into annuities and things that are fixed because you're limited on your income. Well, at least you're guaranteed on income. Well, guarantee 120,000 in income and let's risk the 60,000 income. Don't risk the whole 180 if that's what your number is, or the $100,000 income. Well, I get 30,000 from Social Security, but I need 70 from my investments. Oh, well, hope it works out. If the market crashes, now you have to only spend 35,000 because that's the percentage now. If you have to change your discretionary or even your necessity spending on a monthly basis based on what the market did last year, what it's doing currently, then you're going to always have to make adjustments and you're always going to have to hold back for the future rainy days. If you structure your assets to where you have some income producing assets that guarantee income no matter what, or at least can predict income on a tax efficient basis like we use, then you can have that income part set up. So if you had a $2 million estate, I just use that as an example, you lost half of it, you have $1 million in the market, that would kind of stink. What if you had $1.2 million in assets that would generate that same $100,000 a year in guaranteed income that you were getting from the $2 million at a 5% withdrawal rate, which Wall Street would say is too high anyway. But let's just say you could get out of 1.2, that gives you $800,000 that you could still sit on. And let's say you could still get, if you set it up right, that 1.2 would buy you the $180,000 guaranteed lifestyle, as long as they don't quit sending Social Security paychecks and your pension doesn't stop or whatever the other income was coming from. That's probably a guaranteed source. And I'm just basing this on 2 retired adults that are top of the pyramid on the Social Security payouts. That'd be probably, in the 80 range a year just on that. And so another 100 coming from your investments. What if you could do that 120 and have $80,000 when the market crashes, it goes down to 400. And by the way, we typically don't let the market go that far down. We don't ride the whole market down. Typically, we'll offload when we see markets in trouble and the trend definitely down. We kind of sit on the sidelines. So we can do that because we're nimble and we're active money managers. We're not just, let's park it in the market, take a fee and see what happens. What if you were down 400,000 instead of $1 million and you still had your $180,000 coming in? You don't have to cancel your vacation. You don't have to not buy that new car that you had planned to next year, cash with the trade in because you still have that money. Well, by the way, that 400,000, you're not touching that. You're not locking in losses. You're waiting until it comes back. Even if it did go down to 4 and you were in the market, the last big crashes, it took 5 to 7 years, but so what? You're still making the 180. And if you need a little bit extra money, you probably have some there if you needed it, but you're locking in less losses than you are if you have the whole $1 million going down and you're using $100,000 for the next 4 or 5 years while the market recovers. And then you find out when the market gets back to even, you still only have $1 million in there because you had to spend some of the depleted assets to live on. Anyway, I don't know if you're following the picture verbally, because I know I talk fast and I'm kind of setting up a scenario that has played out during my retirement planning career at least 2 times, 3 times, really. We've seen people get shaken out during the COVID and shortly thereafter, between the 20 crash and the 22 crash. A lot of people are just too nervous to get back in the market, never made that money back. And so they did deplete assets. So we've seen that happen 3 times in the last few decades. It really leaves people hanging. We don't want to do that with our clients. We don't want you to be in that position. We want you to be okay no matter what happens, knowing that you have time for that risk money. And you might even find that the other 800,000, maybe you only want to a 400,000. You want to be really risky with it. And so that money might be the stuff that goes down 50%. So now you're only down $200,000, but the other $400,000 you have for that extracurricular and surprise expenses that might come up should you need them while the market's recovering on the other 400 that took a beating. The markets in 2000 and in 2007 and 8, when the market crashed for the dot-com bubble, and the market crashed because of the banking bubble, where everything was overhyped, oversold, overpitched, lied about, and basically misrepresented, just like we're seeing in the AI business and the tech business right now. They're presenting earnings numbers that aren't real. They're presenting future estimates that aren't real. They're assuming that every company in any business has 100% of the future market share. They don't. They're going to share it. There's going to be competition, just like there was in the dot-coms. There's going to be a few emerging companies that rise to the top, and they're probably already existent. They're probably already big companies, unfortunately. So what are we going to do? Are we going to just ride the same wave and never learn our lesson from these prior crashes? Or are we going to say, you know what? We've been here before. There's been euphoria before. There's been overhyped markets before. And every time there's a new technological advancement or something that gets overhyped like we're having right now, it always creates a bubble, and every bubble is popped in history. So if you're not prepared for a bubble, if you're not prepared for a pop, you don't have a plan that weathers those storms, that's the biggest one, then your retirement plan isn't safe. And there's a lot of do-it-yourselfers that just listen to the pundits on TV that want you to keep your money in the market because that's how they build their model on your money. They don't care about your losses. They just care about the house money, just like a casino. They don't care if the gambler comes and loses. In fact, they want the gamblers to come in and lose. They want to take the money. That's the way Wall Street is. They're working against you. They're working against all of us. We have to be very careful how we jump in and out of the markets and make sure we're in it at the right times and that we need to hedge at the right times. If you don't want to time the market on all your money, then park your money in principal protected accounts that we use that don't go down when the market crashes, but go up when the market goes up. We've had double-digit returns for the last couple of years on many of our principal protected products. We've had some principal protected products that have held their own, but they're not going down. They're still generating income. They're still generating peace of mind. They're still generating a plan that can weather the storms ahead. And we know there's going to be storms ahead. We just don't know when they'll come. You can have a market crash in 2 weeks, 2 to 4 weeks, 2 to 4 months, or 2 to 4 years. I don't know. The bottom line is they do happen, and you need to be prepared. You can't just leave your retirement dreams to a what-if market that you can't control and just hold and hope the market holds out for the rest of your life. Because I guarantee if you're planning on a 30 or 40-year retirement, you're going to weather some crashes, not just little corrections. You're going to weather some crashes because that's just what happens over that kind of a period of time.
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management with an office here in Tucson and also up in Mesa. We're talking about whether or not a solid retirement plan will make it through any economic storm. Again, if you'd like to sit down with Jeff and talk about your retirement plan, maybe get a second set of eyes on the one that you have, our number 520-780-9059. 520-780-9059. That's the number that you'll call to get your Premier Retirement Roadmap. Absolutely no cost, and there is no obligation. It's not going to cost you a dime. It's just a casual conversation to get another set of eyes in this retirement plan and see whether or not we can make a difference in your retirement. Again, the number 520-780-9059. We're also online at premret.com. Jeff, let's change the scenario here just a little bit. Forget the stock market for a moment. What if the economy goes into a recession like we had back 2008, around in there? Does a well-designed retirement plan really care about something that dramatic?
Well, again, that's why we prepare for the worst. We hope for the best, but we prepare for the worst. We're going to have some recessions. Recessions are called recessions because it's a reset period. That's what it does. The market resets, the economy resets. There could be a little bit of deflation. I think it's funny because we're already in a recession, if you ask me. If GDP is only growing at like 1.5% or 2% max, and we've got more than that in inflation and population growth, and we're really not growing at all. That's just the natural growth just based on population and inflation. It's not doing much at all. China is just up in arms about how bad their economy is because their GDP is falling down from its lofty levels of 7 to 10% down like 4 or 5%. Shoot, our U.S. hasn't seen 7 to 10% in a long, long time. They haven't seen 4 to 7% in a long time. It just ekes along, barely. The only thing that's really building it is the AI, the infrastructure, the data centers, and all that kind of stuff. And I'm afraid we're getting a little bit overhyped and overvalued, and we're putting all our eggs in that one basket. While every other economic indicator is suffering, housing is slow, nobody can afford to buy a house, interest is too high, car sales are down. Just about every economic indicator out there, if you look at the economic indicator index, it's been falling every quarter for the last, I think, 3+ years. So we're already kind of headed towards a recession. And what usually happens is interest rates can typically put the kibosh on it. And typically interest rates have to be pushed up higher in order to curb inflation. And we've had so much printing of money the last few years to get us out of jams, which I think, I don't know how much money they can print. Some people say QE to infinity. I just don't know how we can stretch the rubber band that far. And we found out that we can't without some inflation, which means what are we going to have to do? Raise interest rates. Well, interest rates go up. Well, that kind of increases the value of the dollar. It increases bank stocks because people like higher interest that they can get on savings rather than go on the market. But it also freaks people out about taking risk to try to get 5 or 6% that they could get without risk in the market that's overvalued. And so people will typically, when we see interest rates go up, it'll typically cause a market correction. People get scared and then they stop buying things because their portfolios are down, the 401ks are down, their investments are weak and either losing money, resetting, or even crashing. And if that's the case, and people stop spending money where they're already kind of at a slow pace spending, by the way, rich people, I would say the mass affluent, the affluent people, the people that have incomes over $100,000, $150,000, people that have net worths nearing retirement in the million range, they don't seem to be curbing spending. They're still buying what they want. And they're trying to be responsible with their money. But the middle class, the up-and-comers, the people like our kids' generation, the people that are trying to make ends meet, don't really have a choice because they don't have that nest egg of investments. They've been overpaying in interest for houses. They've overpaid for prices of houses, cars, everything that's gone up in the last 3 to 5 years, especially. About 30% inflation since Biden took office, roughly. And most of it took place while he was in office. Lately, it's starting to get bad again, but it's certainly not near the levels that we saw in the early 2020s. That stays with us, and that causes recessionary pressure. So I think we're already headed there. The only way to really get us out of a recession is inflation has to start getting in check, which usually means interest rates have to stay a while. The economy has to stay weak a while until the Fed is kind of forced to lower interest rates to stimulate growth, to stimulate confidence, to stimulate buying. And as that happens, even the company stocks will start going up because they can borrow money cheaper. They can put more money into R&D and pay less for it. Right now, as interest rates go up, it is squeezing the tech market a little bit more than it probably should. And that's why the tech companies are doing accounting in more creative ways so they can offset the cost of their outrageous capital expenditure notes and loans. Some of them have more loans outstanding than cash flow. I just don't know that that sounds healthy. But bottom line is, we're probably heading to a recession pretty much at the same time the market corrects. Market kind of is a reflective of that. Sometimes they cause one another. It's not necessarily one before the other. Typically, they end up overlapping at one point, depending on what starts. It could be a market crash starts the recession, or the recessionary pressures get too hard for the market to overcome as well. So rich people can do a lot, but if they start taxing the heck out of them like they say they will, they won't have as much money to invest. That's going to hurt. If more and more of the middle class keeps getting into the poor, I can't afford it class, that's going to hurt. And what are we going to do? Well, can you withstand the inflation? I think they'll curb that with interest rates. But fortunately, a retiree with a good plan probably doesn't have a whole lot of debt service. They probably aren't going to care if interest rates go up, other than the fact that they can buy higher paying CDs again, or savings accounts that could pay them interest on their safe money instead of letting their emergency money accounts not pay them any interest. That's actually a good thing. It's not going to affect annuities that are already in place and already structured for lifetime payouts. It's not going to affect LERPs really, because they still make money when the market goes up, because we use indexed IULs for the LERPs, life insurance plans. That's going to go up tax-free every time the market goes up. And if it goes down, it's going to weather the storm of a crash because it's set up to do that. The same as it is for our index annuity, principal protected assets over there too. There are some buffered assets that still have some downside. We don't really like buffered. We like either principal protected or just all in. Let's go risk on and make the money when it's there, and let's be careful with it when it's not. So a good diversified portfolio is going to take advantage of every scenario, but it's going to protect you from times that I think are not too far ahead. And I've been saying this for a few years, and it doesn't always happen when you think it will. Warren Buffett's been raising cash for as long as I've been saying. I think it's getting a little sketchy how expensive stocks and things are getting, and as weak as the economy really seems, other than tech stocks that are driving the market. And so I'm not the only one, but I kind of watch what smart money does. And smart money seems to be a lot more cautionary than the Main Street investor who is listening to the hype on the news and making trades the next day. And 80 or 90% of those people lose money every year. So again, a plan that's a little bit more structured, that gives you peace of mind, where you don't have to make changes and react to market changes, is the best way to go. You've already reacted and you've done things that will set you up so that when those things happen, you don't have to worry. You can wake up and know all your bills are paid. That's really the bottom line.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management. Once again, our number 520-780-9059. Jeff, here's the $1 million question. A lot of people listening probably think they have a retirement plan. How do I know whether I really have a solid retirement plan or whether I simply have a 401k, an IRA, and some investments?
Well, I think a retirement plan has got to have an expectation and some guarantees that your future income is going to meet your needs, or at least if it doesn't meet your needs, that you're able to adjust your spending habits to be within what's reasonable. It reminds me of a couple of recent examples. I had a person actually call me in from the radio show, and they like what I was talking about with markets and all that kind of stuff. And they're out kicking tires with several different firms. And, one of the firm, they came in and said, how come all the other firms, by the way, all the other firms that they went to pretty much are just really focused on money management. They don't like principal protection. They don't like the limitations that annuities put on people from the upside. Like if the market goes up 20, you only make 9 or 10 max on these other products. But they're forgetting to remember that when the market goes down, they don't lose half. Yeah, but that's okay. I've got a couple $1 million and you're fine. You'll never run out of money. Well, really, some of these people that are saying that have never been through a couple of market crashes. They never had clients through market crashes. They've never had a story like Norm, like I've talked about in the year 2000 when he had $1 million in the market and everybody said, oh, you got plenty of money. I mean, shoot, the market average is 10, you'll be fine. And he wasn't fine. 2009, he was almost out of money when he came and saw me. 10 years later, he was only in his barely 70. I'm trying to say, that's fine. You've worked a lifetime to get there. And everybody says, oh, you're fine. Let's just manage your money. And they're like, well, why would they say that? And why are you not saying that? Well, they would say that because the bigger assets under management they get, the more fees they make, the bigger they can sell their firm for. That's really kind of the model nowadays is investment firms typically want to build a valuable firm so they can sell out, cash in and move on. Kind of like the private equity market. It seems to be kind of the norm. And some of the companies that are they treat you kind of like a number. They probably make you feel all warm and fuzzy when you come in and talk to them because they say you're fine and they say everything you want to hear. But the bottom line is I've been through this for 40 years now. And in a market crash, you're not fine. And you're going to find out you aren't going to be good. You're going to freak out and you're going to say, oh my gosh, I only have 1 million now, not 2 million. And they say, I'll still be fine. Well, that's okay. Just adjust your habits. Just, don't ride first class anymore. Well, don't buy that car this year. The market will come back. Well, do you want to be making those adjustments all your life because based on what the market does rather than have, you'll be fine if your net expenditures are going to be $180,000 or $200,000 a year. You want $15,000 spendable a month after taxes. Then you can't just say, well, I got 2 million, that should do it. And don't worry, you'll be fine is not the answer. That is not a plan. Well, you've saved good. You got a 401k, just move it to us. We'll invest it. We'll do great. Because look at what we've done the last few years. Okay, great. Well, what have you done in the last market crash, like back in 2008? Bottom line is half these people weren't even in business back then. Well, I don't know. Well, we did just fine because, you were working back then. You had a paycheck. You didn't have to care if the 401k went cut in half. Well, now you've got your nest egg. You don't have a job. You don't have income. What are you going to do? You don't have a plan unless you have something that generates income that is going to cover all your expenses. That's really the bottom line, is really income. And then there's a big factor of that income is how much of your income are you going to give the IRS? You going to give a third to the IRS or are you going to keep most of it? How about if you give 20% now for the next 4 or 5 years, and then you give less than 10% for the remainder of your life because you did some effective tax planning with Roth IRA conversions and LERP planning and things like that could be more effective. We can put more money and more income in your pocket by doing effective tax planning in addition to just choosing products and services that guarantee income. We still want to take some risk. We like risk on money. We like the market. We like the upside. Shoot, we had a crazy good year last year. Both of our growth accounts, I probably shouldn't even say the number because you'll think I'm fibbing or you'll expect that to be forever. Past results are not a guarantee of future. We're a little softer this year because we're taking a little bit more precautions. And honestly, the market is really tweaky right now. It doesn't mean we're going to be forever. But when we're on the verge of a crash and the market's is volatile, changing, like one day tech sector's hot, next day it's banks, next day it's consumables. You don't even know what area the market's going up any given day. The indexes seem to be bouncing around. They don't really seem to have a direction. Bias is up because of some manipulation right now, but that doesn't mean the market can withstand this kind of manipulation forever and go up forever. We're already seeing kind of a rotation back into gold and silver, which is typically more of a hedge when people are a little bit more sketchy of the market. We're seeing people willing to buy bonds, even though the interest rates going up is going to lower the value of those bonds, but at least they're locking an interest rate that they can be happier with rather than risk. So based on all the things that we're seeing now, we're in cautionary times. You need to make a plan that works. And the difference of being just a hold and hope method and being at the mercy of something you can't control and something that's as big and as ruthless and as just mean as the markets can be is not the place I want my retirement money to be. And it certainly isn't the place I want my clients' retirement money to be because I don't want to be staying up at night worrying about your money any more than you do. So let's be on the same team. Let's set you up a plan that you can count on. Let's be happy every time we have a review because we know all our bills are getting paid. We have a travel budget that's acceptable. And also, what about the money that's in the market that isn't doing very well right now or some period of time? Because over time, it'll do great. And we don't have to worry about spending it on a monthly basis or needing it for an emergency because that's what it is. It's the risk on money. It's the money that we can play with, the money that we can set at risk and not worry about because the market is volatile. You're going to go through some times that your gut's going to get sick. and your brain's going to hurt because you're not sure if the market's going up or going down, or if you're going to be able to pay your bills next month or not if you don't have a plan. If you have a plan, you don't have to have those feelings. You have exactly the opposite, and that is peace of mind, confidence that you're going to be okay.
Great conversation, Jeff. Again, I think the economy matters, the markets matter, but a solid retirement strategy should mean that your financial future doesn't depend upon correctly predicting either one of those. If you're approaching retirement, already retired, you're not sure how your plan will hold up through the next bear market, recession, inflation spike, or change in interest rates, give us a call here at Premier Retirement to talk with Jeff Vogan. Our number 520-780-9059 will help you stress test your retirement strategy before the economy stress tests it for you. Once again, the number 520-780-9059. You can find out more about us online at premret.com. Time for a break, Jeff. When we come back, we've got listener questions, and later on, DIY retirement planning. Is saving the advisor fee actually costing you money? All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thank you for making us a part of your weekend. Of course, you're listening to Premier Retirement with Jeff Vogan. I'm Jeff Shea. We're here for you every week for your fiscal fitness and your financial education. We're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and of course on Sundays at 11 a.m. And if you've missed any part of our program, of course, you can join us on our podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. And we're online at premret.com. All right, Jeff, time for listener questions. Richard's in Dove Mountain. And Richard writes, what are your thoughts on investing in multiple index funds versus one? For example, investing in multiple amounts in 10 different funds versus all-in-one funds to possibly have a better average return overall and have less losses if some perform better during the market downturn. I hear Dave Ramsey talk about mutual funds a lot. What's the difference between a mutual fund and an index? What are your thoughts on investing in both?
There's a lot of overlap and redundancy in a lot of the indexes. If you're going to buy 10 different S&P index funds, you're getting pretty much the same return. You just look at the fees and you can pick the right one. I like ETFs for indexes just because their exchange traded funds are cheaper. Mutual funds have hidden costs, trading costs, admin fees. Sometimes they give 12B1 fees, which is kind of a kickback to the advisor or the broker that sells it. If you're going through Vanguard or Fidelity, they've got their own proprietary products. You can buy others from there, but typically that's when the companies would send a 12B1 fee and maybe mute the returns a little bit. Index funds are great, but you're going to have the ups and the downs. So if you're talking about 10 different funds or indexes, including like the NASDAQ index or the Dow or the S&P, those are the main ones. Russell, maybe. You can even do the Wilshire 5000. There's 5 indexes right there that you can do that are totally indexed. And honestly, with the market as volatile it is right now, I think right now is probably a better time for the indexes. However, when the gas runs out and there's a sell-off in one big sector, when the tech starts selling off and it looks like it's in a downturn right now for the last 6 weeks, maybe a little bit longer from the end of June, basically, there's really just a downtrend. It keeps on trying to pop and they keep on hyping it and they keep buy the dip. Well, every dip you buy is lower than the last dip. So that looks like a downtrend to me. So if the market finally gets wise and realizes that we're not in a tech uptrend, and if we don't end up going back to those levels, we might see a much more broad sell-off because there's only so many other things that the market can manipulate to keep the indexes up. So again, you still have risk. If you're in the indexes, you're in the market. It's a lot simpler. If you're going to do it yourself, that's probably the best way to do it because it's hard to stock pick. If you're not doing it for a living, you've got other things to do. You might want to just play the index and also diversify. If you want indexes, but you want just the upside, none of the downside with some of your money. Now, I don't know your income situation. You might have massive pensions and you don't really need this money. So if the market crashed 50% and these indexes all went down 50%, and just because you have 10 different indexes doesn't mean if the market goes down 50, you're going to average only 40. You probably average 49 or 48 or 52 or 53 just by having different indexes. In 2000, when the market crashed, the S&P went down 51%, I think, or 53%. I think the Dow was 51 and the NASDAQ was over 80, 82 or 83. So you'd have been better off having just one of the indexes, and it would have been the Dow or the S&P that was a little bit more muted. Nevertheless, you still lost 50% of your money. And if you had mostly tech stocks, because those were the drivers of all the market, and those were where the dot-coms were, and they were so overhyped, everybody had to have them, that market fell 80%. So if you had $1 million in savings, now you've only got 200. If you're living on that money, it's not a good thing. So that's why I say, if you want all your money in a whole bunch of index funds, you're still at total risk for everything. And if you think bonds are a safe haven, they're not. The only thing that's a safe haven will be short-term bonds or money market. Now, you hear Dave Ramsey talk about mutual funds. I do too, a lot. I've recently was at an event that Dave Ramsey was a keynote speaker. I think he's a good guy. He's a really well-meaning guy. He's better at getting yourself out of debt, but he is not a good advisor. He's been fined and sanctioned by all the industry because he is not licensed to give financial advice, yet he does. He's good at budgeting advice. He's good at general financial advice. But for him to say on the radio that in a good mutual fund, you'll make 25% a year. Well, there's no mutual fund that over the long haul makes that kind of money. Over short periods of time, it does. During bull markets, it does. But those ones that he's talking about, a good growth fund that makes 22 to 25%, just like the market, will end up crashing 50%, just like the rest of them. And if you're using Dave Ramsey's theories in retirement, you're going to lose your money, because if you back test, and I've seen his stats, if you back test his plan to just keep it all in mutual funds and live off it, and not worry about it because you're debt free and you can still live off plenty, you've got about a 15% win chance if you're going to retire for 30 years. And you've got a big chance of losing if you have all your money in that type of an aggressive mutual fund that he's always touting. So be careful. And by the way, mutual funds typically have higher fees. If they have better performance, then by all means, go into mutual funds. We do sometimes. And we do charge fees on top of that for our services of finding those mutual funds. Sometimes people say, why are you selling mutual funds? They have higher fees. Well, the same mutual fund and the same ETF, exchange traded fund, aren't necessarily the same when it comes to actual performance. And there might be reasons that you buy funds. So you can buy an exchange traded fund with lower fees. That's where I would buy the indexes. Mutual funds, I would do that with if you found some guy that was just a super good growth manager, an ex-hedge fund guy that really knows tech better than other people, maybe you buy a tech fund that's managed by that particular firm or that particular manager. I would invest in principal protected assets that are associated with the index, so you at least have some of your money that doesn't go down in the next market crash. And I would make sure that your income is guaranteed before you start risking any money in the market, period, regardless of what Dave Ramsey says.
Richard, thanks for listening to us in Dove Mountain. If you would like to further the conversation with Jeff, the phone number is 520-780-9059. Next question, Jeff, William in Catalina Foothills, and he says, my wife and I decided at the beginning of 2026 that we'll be retiring in 2030 when I turn 65. Because of our ignorance, we've been heavily invested in stocks. Now that we've learned about sequence of returns, we want to change our investments to something more compatible to our age. We've been looking into target date funds. Is it a good idea to switch to a target date fund, or do you have better recommendations?
Target date funds are overhyped. Usually fees are worse than others, and often they charge a fee for a target date fund, and they have securities and funds inside them that also have fees. They underperform. They're just an easy way for 401ks and other mutual funds to sell a basket of funds without actually having to do any work. They hype, oh, you're going to retire in 2030. Well, buy a 2030 fund. That 2030 fund probably has more than half of it still in stocks. And if the stocks crash, you're still going to lose 25% of your money. If interest rates continue to go up, you could lose another 10 or 20% on the bond portion that's in that target date fund, not to mention maybe 1 or 2% in fees on top of that. So you're still at risk. I think securing your income because of sequence of returns is very important. Like the 2000 and 2008 crash, there's really not a target date fund that would have beat a mixture of index annuities with S&P indexes and basically indexed accounts associated to them, with the guaranteed income riders now that they have are even better than what used to be available. Less bonds, more fixed returns on principal guaranteed accounts, and maybe less in the market. So maybe you put half your money in something that'll generate income, so that at 65, that at least your lifestyle will be kept up between the Social Security that you'll be getting at that time, minus the payments you pay for Medicare. Over and above that, you need to make sure that your investments work for you and create that guaranteed income. And that way you can maybe take a little bit more risk. In my opinion is take more risk, be more aggressive on less money, and be more protective on more of your money. Have 100% downside protection, no downside risk, and have only upside in income with that other portion of funds. Wall Street doesn't like that idea, although I did hear that both Fidelity and Vanguard have actually written in publications that annuities really aren't as bad as they said they were. And that it turns out that after Ernst & Young and some of these big four accounting firms actually did a study and found out that a retiree can live on more in retirement if they have a combination of indexed annuities, life insurance, IUL specifically, and a certain amount of money in the stock market that they don't have to touch on a regular basis, but that can be allowed to grow for the future inflation, future what-if expenses and things like that, or for even legacy planning. After a couple of crashes, we decided to go more of a comprehensive, responsible route rather than doing what our broker-dealers and everybody we worked for told us to do. We decided we work for the people and diversify into these different asset classes, use all the tools that are available, and protect income, reduce taxes, and actually create more guaranteed and predictable income in retirement than just the stock market focused investment strategies that Wall Street always touts because they want to keep making fees over and over again on the same money forever. We like to park some money that serves you. We like to make sure that you're okay forever and don't have to basically change your lifestyle based on the whims of the market. And it might not be in the best timing based on your lifestyle or where you are in your life cycle. Again, a lot of big, very credible sources have underscored our 20 years of planning where we've gotten beat up by the markets. And yeah, everybody else on TV said, oh, don't buy annuities, don't buy this, LERPs are stupid. I mean, even Dave Ramsey says that kind of stuff. Well, mutual funds make more money. Well, they do if you just leave them alone and park them for 20 years. But in retirement, you're not leaving alone and parking for 20 years. You're using that money. It becomes a totally different game. I don't dog on Dave Ramsey. He's a good guy. He helps people get out of debt. He helps people save. I think he's a great person to help you get a handle on how to accumulate assets, how to get ready for retirement. But as far as retirement plan, I think he leaves that to us. And I think we can take it from there and make sure that you protect your life's work and make it work for you without the risk of that sequence of returns risk, which is a very, very valid risk and probably the most important risk. And congratulations for figuring out before the market crashed. That is a very valid concern. And one of the most important risks out there is the sequence of returns. We know the stock market is going to average great returns over the long haul. We just don't know when they're going to come, and we don't know when the next crash is going to come. And that sequence is going to mean everything to you. And again, I'm going to refer to the story of Norm. He had $1 million in retirement in the year 2000 and quickly had $250,000 and couldn't end up making ends meet and made some of it back by getting a part-time job and taking Social Security earlier than expected. In 10 years, he was barely swimming with about $250,000 in his account. Again, he's 70 years old at this point. He retired at 60, ended up keeping his money in the market because that's what conventional wisdom says. Oh, just keep it in the growth funds. They're doing great. Keep it in the market. Over time, it beats everything. Well, it does over time, but not in the first 3 years into retirement like Norm. He basically died on the retirement mountain. He died up there. He got to the top and thought it was all downhill from there and wiped out and basically died on the mountain, so to speak. His retirement plan is no longer functional because he didn't know about the sequence of returns. And quite frankly, in the year 2000, I wasn't aware of sequence of returns. That's how I learned about it the hard way with clients that lost real money, with real clients that I cared about, and that unfortunately didn't do that well. Now, unfortunately, Norm was not one of my clients. I was actually a little bit more diversified and conservative than he was. But 10 years after the fact, he's telling me the story of why he's out of money. And I'm like, oh my gosh, you left everything at risk. Sequence of returns got you. And now we just had our second crash, the banking crisis. And he's telling me the story. He's, yeah, I thought it hit me once and it was an anomaly and I could wiggle out of it. He says, then it hit me again and now I don't know what to do. And honestly, I couldn't do really anything for him at that point. And we don't want you to get in a point where we can't do anything for you either. Let's set it up before it happens, before that sequence of returns bites us in the rear. And it could happen anytime now. It could happen now, next year, few years. I mean, I don't know when, but the market always does what it's supposed to do. And it's supposed to get to a rational level eventually, and it will. It will return to that because we're way over what's considered rational for valuations and so forth in the market. It's a big casino. Warren Buffett said that several times just in the last few weeks. He's like, I can't invest in a casino. This is crazy. It's like putting a casino at church and wondering why people aren't listening to the sermon. And so I think people are distracted. They got FOMO. They don't want to miss out on these great gains. But congratulations for you for having some wise thinking, especially as you decide to retire in 4 or 5 years. I think now's a good time to protect your life's work and make sure that it's there for you.
William, thanks for listening to us in Catalina Foothills again. If you'd like to further this conversation with Jeff, 520-780-9059 is the number. Okay, Jeff, Glenn is listening to us in Green Valley. Glenn says, I've been a Vanguard customer for many years with both brokerage and IRA accounts comprising index mutual funds. Vanguard is offering a direct conversion from my open-end index mutual funds to their exchange-traded counterparts without incurring a taxable event from the transition. When I compare the ETF to the index fund version, I see that the year-end distributions are the same or higher with the index fund. So I'm wondering if converting the ETF version is really worth the effort. I understand that they're both traded daily.
Yeah, they traded daily, rebalance daily. We do the same thing in our portfolio management. We rebalance daily and we trade. If there's a new opportunity, we take advantage of it, just like funds do. I mean, that's a good thing. But ETFs typically, it's interesting that they're going to do a conversion and not have it be a taxable event, because in a mutual fund, they're trading so often, you're paying taxes every year on everything anyway. So your basis is probably close to zero as it is. Either they're going to foot the bill or they found some loophole in the tax code that I'm not aware of to do that. But one thing about ETFs is whatever they trade, if they make money as they make money, you're not going to get a 1099 at the end of the year based on trading activity that happened within that fund or dividends that got paid within that fund. The ETF is all intact. It's basically reinvesting the dividends and interest and not paying tax on the gain. So I like ETFs better just because of the tax structure. To my knowledge, they haven't changed that tax structure on mutual funds. But if they're going to give you a conversion loophole, that could be something brand new that maybe I need to talk to Taylor or our CPAs that are more savvy on the taxes to inform me. But I hate to sound ignorant, but I didn't know that you could do that. And I don't know if it's only some mutual funds, because some mutual funds trade and zero out at the end of the year. So there's always, your basis is always caught up and there is no tax because you're paying it as you go. But the nice part about ETFs is you won't pay it as you go. In fact, you'll only pay a capital gains tax when you sell it. And if you hold it for more than a year, it's a long-term capital gains, which is a lower bracket than your typical earned income or ordinary income, which is what is generated from all the transactions during the year from a mutual fund. So I prefer the ETFs given equal to equal. If the year-end distributions are the same or close, I don't think you're going to lose enough. I think you're going to gain more in taxes than the slight difference if the index fund, mutual fund is actually paying more. But, I could be wrong. Is it worth the effort? I would do the effort, but what I would really do is look at your options, because index funds are still going to get hammered. ETFs are still going to get hammered if the stock market crashes. And you might want to rethink your risk. As the last question William asked was, what about the sequence of returns? Can I withstand a market correction of 20, 30, or 40, even 50% that takes 5 years to recover? Am I going to be okay in ETFs? That question is going to be so irrelevant. You're not even going to think of that question if that happens. So what you really need to think about, I think, first question on your mind is, are you okay with the risk? And if you have other income and you're totally okay with the risk, then go the ETF route. But if you really want to look at your overall plan and get a feel for avoiding the really bad things that could happen in the future if the market corrects, and if the exchange rate funds and the mutual funds all go down together because the market's resetting and we're in a recession or even a depression, and it could happen. Again, I'm not a doom and gloom guy. I'm just saying we have to prepare for these things because they do happen. It's just like you have car insurance, don't you? Why? Because you're planning on going out and crashing your car? No, you have it because it could happen. And we want to insure against the next market crash too. So let's insure against it by taking some of those profits off the table, principal protect them, generate some income, and leave the rest to chance. But the rest to chance, I prefer ETFs.
Glenn, thanks for listening to us in Green Valley. And again, if you'd like to talk to Jeff further about this, 520-780-9059 is our number. That's the number that you'll call to request your Premier Retirement Roadmap. No cost, no obligation, no judgment. Just a casual conversation with Jeff. Once again, that number, 520-780-9059. And of course, we're online at premret.com, PREMRET.com. Jeff, investing has never been easier for the person listening to our program today, the DIY investors. I can open an account online. I can buy low-cost index funds. I can use retirement calculators. I can read about Social Security and Roth conversions online. And most importantly, I can avoid paying an advisor fee. So if I'm reasonably intelligent and financially disciplined, why shouldn't I just try to tackle retirement myself?
Well, you can. A lot of people do. Some people are really good at it, and some people have nothing else to do in retirement but to study the market every day and learn about different things. It's hard to get access to some of the principal protected products that we like the insurance. I mean, I don't know how you're going to, you don't really buy insurance over the counter. You find an agent to help you choose the right plan for you. So you have to probably go through that anyway. In fact, I had a guy that retired from a big insurance company, and he was a VP, really high up. And he goes, I want the best annuities in this company. And so I gave him the ones, and He called his company, tried to circumvent me, tried to buy him direct. And they said, well, you need an agent. He goes, why do I need an agent? I work there. He goes, well, because you need an agent. And so he called me and goes, hey, I tried to go around you. Sorry. Hey, I still wanted the guaranteed income that I know we provided for some of my money. So I guess since you helped me, I'll give you the business. And that's kind of rude, but I'm glad he called me back. But that's just how it works. So if you want to just buy an index fund and sit and wait and just see how it goes because you don't really need to worry about a plan, that's fine. If you don't really have a tax bracket to worry about, you'd probably be a good DIY investor. But we maximize people's Social Security payments. We navigate around the taxes associated with Social Security, associated with your Medicare premiums. The IRMA, do you know that if you take an extra chunk out of your IRA that your IRMA could double or triple or even quadruple? IRMA, that's your Medicare premiums. They could go from $180 a month to $580 a month if you're not careful, just because you wanted to take a withdrawal out of your IRA and spend it on something cool. And you didn't know that. Well, how much is that going to cost you? Well, I had a lady bought her daughter a house for $400,000 and she had a little over $400,000 in her IRA, just thought she'd pay for it. Because she remembered it was tax deferred. She wouldn't have to pay taxes on it. No, it's tax deferred until you pull the stinking thing out. So she bought her daughter a house, wondered why the IRS is billing her $150,000 in taxes. And she says, well, I don't have it. I said, well, then tell your daughter to sell the house. And by the way, why didn't you ask me first before you yanked the money out and bought her the house? If somebody does that on their own, I get a letter 2 weeks later and say, well, what'd you do with the money? I could find out that they did it late, rather than have somebody come and ask me beforehand. So, I mean, sometimes questions like that are more than, she would have saved more in taxes just having to structure the purchase correctly by not having to use taxable funds than she'll ever pay me in fees, even if we continue to work with her. We're going to minimize your tax payments, your IRMA payments every year. Most of our clients, if we look at a plan, very often we can see hundreds of thousands of dollars, even millions of dollars in tax savings if they do certain activities in the next few years rather than do them for the rest of their life over the next 30 or 40. That money is more than enough to cover taxes. Do you ever need somebody to just call and talk to? Well, you could call the guy over at Vanguard or Fidelity that sits there, just got his job 3 months ago and thinks he knows all the answers and doesn't know anything because he's never actually been an advisor. They're just customer service people. They don't even have advisors. If you do have an advisor over there, they typically charge you a fee on top of a bunch of funds that have fees. So you can be killed if you start using the companies that you think you're being a DIY investor with. It's even going to be worse. And you don't even know how deep the fees go sometimes when you try to do it yourself. Are you going to get the news? Do you have access to things like insider buying and selling? Like how often is the CEOs and the board members of this company selling or buying their own stock? That's a big indicator of what they know on the inside. And that's a legitimate thing that we can actually buy that information. You can also buy the information. Are institutions putting money in? Are there more people buying the stock or selling the stock? And interestingly, sometimes the stock will go up even though there's more sellers because the market makers are manipulating the market by just raising the sell price, but they're unloading it and they're making people think, oh, this one's going up, we should buy. All the while they're selling. We can tell where those sells and buys are coming from. So if you're trying to pick stocks or looking for things that have good momentum with money following or directing those buys and purchases, not just the price is going up or just the trend is going up or down, we know why it's going up or down. And we typically we always try to stay on the side of following the money. Now, does it always work? Shoot, nowadays, trends can change in a day. So you have to be very nimble and very aware. So if you're not able to trade on a day-to-day basis and watch those things and see how they change, then you're not going to do as good a job as somebody that's involved in it on a day-to-day basis. And not only am I involved in it for my own portfolio, but my own portfolio is divided into different parts that mirror what my clients have. So if they want more growth and they have more of the growth portion in my own portfolio. So I'm watching everybody's portfolio every morning all the time. I'm not having to dial into 8,000 different mutual funds and see what this guy has and that guy has and the other guy has. We just deal with how much risk you want and you get to watch the trades and you get to see if we're doing a good job. And if you like it, then you hang with us. If you don't like it, you can go do it yourself. You only pay fees for while you're with us. But when you start adding up what a plan would cost you and the hours we put into a plan, what the tax savings we're going to offer, how much money we're going to save you on Medicare premiums by telling you how to withdraw in the right sequence. If you're doing this your first time, it's like getting on a boat and driving on a lake you've never gone on before, and you have no idea where the rocks and the obstacles are, and you end up sinking your boat because your first run out, you didn't even know what to look for. But we've been skippering this boat for 40 years, and we already know where the low shelves are, where the sandbars are, where the rocks stick out, and the obstacles we want to miss, and what the weather looks like when we need to go back to shore and protect ourselves. So, yeah, we've been sailing on these waters for a long time. If you want to go out your first time and say, well, I'm a smart guy, I can drive a boat myself. Well, I wish you the best. I hope you do well, and I hope you kill it. The other thing is some people want to do it yourself because they only want to buy 2 stocks. I only want Nvidia and Micron. They're going to the moon, and I'm going to put all my eggs in that basket. You know what? Just from a compliance standpoint, I think those are 2 great long-term investments, but they can also, as you know, in a very short period of time, recently lose 20 or 30 or even more % of your investment value. So they're still also volatile. So if you want all your eggs in one stock basket, or if you want to be super concentrated in something that the news has said is a hot buy, we're probably not a good match, and you should be a do-it-yourself investor, because that way compliance doesn't get us in trouble. The SEC, if they audit us, doesn't say, why would you have this person all in one stock? Don't you remember Enron when everybody did that? But Enron was the best stock on the planet, so it didn't matter because it was going to the moon, and then all of a sudden it wasn't, and they were out of money. So again, we try to be more diversified. We also use more pieces, not just more maybe stocks or positions in a portfolio than typically some do-it-yourselfers might. But we also use all the tools that are available that most do-it-yourselfers can't really access or even research thoroughly enough without major software or teams that analyze different aspects of some of the products and things that are available out there, specifically in the insurance business.
Jeff, I'm going to add to this conversation by saying something that I think is really important. We're not criticizing people who have successfully managed their own investments, but I would ask you, do you have an investment portfolio, or do you have a complete retirement plan? Well, Jeff, we're out of time for this week. I want to thank you for your time, but as I do every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week, right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.